right, good morning, everybody. We got a lot going on. A lot of speakers. We've got contagion risk from the currency situation. Today we have additional auctions on the front end of the curve. Here's the bond crisis that's going on over at the Bank of England. They were supposed to end that emergency situation. There's still a lot to it. I haven't had a chance to read through everything this morning, but keep your eye on the FX markets. So other than that, which just kind of gets wrapped into its own little bubble, we have all the Fed speakers today. You can see basically every hour we've got somebody out there chipping teeth. And then we also have the additional auctions today, which we'll get to those when we get over to Thinkorswim. We want to come in and look at what's going on with the anticipated rate hike. So this is the November 2, like we talked about yesterday. 75 basis points is pretty much a done deal at this point. I think the only thing that might change us from 75 would be if we went to 100 basis points. There's no reason to expect that we're going to see that, but just think about for a moment what it would look like if CPI and PPI came in hot, showing, say, perhaps that the Fed is still not managing to accomplish its task, right? That, for an example, might accelerate the idea that we need to get even more aggressive, even more restrictive, and that might change this 75. It's the only thing on the table really that I see that could change the 75, because I certainly don't see it going down to a 50 basis point, right? Only up to 100. It's the November or the December and the Februaries that have the opportunity to really change. And if they unwind some of this, we would see the market rise. And then, of course, if they add to it, then we would see the market go down more. So if November gets us to 375, when we get to December going from 375 to 4, that would be a 25 basis point rate hike. That is a really low expectation, a low probability. To go from 375 to 425, that'd be 50 basis points. That has the highest probability at the moment. So we're talking about going from where we are now at 3 to 375, and then from 375 to 425, and ending the year at 425. That seems a little low. I had seen some estimates that said we would end the years closer to 4.5, maybe 4.75 or 475. But still, 50 basis points is the highest probability for December. And if they increase the probability in December to 75, you're going to see this market take another leg down. So this is one you definitely want to watch for. You want to watch for this middle one, the one that says 425 to 450. You want to see that number decrease, and then you want to see the 450, 475 increase. And that would tell you that they're increasing pricing in that additional 25 basis points. So since this is the highest probability, we'll run with it, 425. As we get into February, what's the likelihood that we stay at 425 or that we manage to go to 425? Supposing that we only had 25 basis points in December. That's a low probability. To be at 4.5 to 475, which would be another 25 basis points. It's got the highest probability. This is the one that I believe has the most capacity to change up or down. So really the November, not really much to waste your time on. Just kind of glance at it once or twice a day, not expecting much of a change. It's the December and the February. Keep your eye on those. If they price in a higher basis point expectation, we'll see the market go down more, right? But if they begin to unwind a higher probability, we would see the market rebound to the upside. Turns out that the consensus estimates for CPI seems to come in a little hot if you use the Cleveland Fed forecasting. They seem to underestimate it quite a bit. This Michael Kramer guy, I don't know. This is just one of those Twitter accounts that I added to the pool that has people that have a Bloomberg machine, right? This is a $25,000 a year Bloomberg subscription. And most of these guys are some form of fund manager, hedge funds, just institutional money manager. So I don't know the guy, but he very often, posts about background or research or things like this that have a lot of insight. So they're looking for an 8.1% rise. That's the consensus estimate for the September CPI. And Cleveland Fed is forecasting 8.2. So Cleveland's Fed is anticipating higher than the estimate. And they usually underestimate things. So if they're going higher, but they very often underestimate, then we can imagine we're going to get a pretty hot CPI, right? That's kind of the expectation at the moment. And if we do, oh boy, right? If we do. So here we have Thinkorswim. Looking at the calendar for today, you can see it's got a lot of front-end auctions, 4-week, 3-month, 6-month, 3-year. And they're all at 11:30 except for one. The 3-year note is at 1 o'clock. This kind of sucks. I hate when we get those afternoon auctions because it kind of screws up, the 0-day plays. We don't know. The auctions have been weird lately. If you're watching Finance Juice, when those auctions come through and they post how much was bought in millions of dollars, and when it says 0 millions, it's a little bit scary and a little bit freaky, right? Like nobody's stepping up to buy. So watch the clock, 11, 11:30, and 1 o'clock. We are below all major moving averages. So if we do start to make any sort of a move to the upside, we're going to have to work our way through those moving averages. Oh, I deleted it. That's too bad. I kind of gamed out a ghost print yesterday of what it would look like if we got a higher low. All right. Guess we're not going to see it. But that higher low is kind of what we need, but it's a little bit of a good and a bad at the same time. Right? On the one hand, we want that higher low because it is the beginning of the trend basis. Right? If you kind of game this out, that's our low. If we can set a higher low here, we would have our higher high, our first higher low, get a move up, we'd set our next higher high, and then our next higher low, right? It would be that process to get us moving in the right direction for that Christmas rally, Santa Claus rally. But moving off of the lows without having first bounced off of something kind of doesn't have a lot of credence, right? Because if we're moving up when we didn't hit anything, then there's not a lot of structure or stability behind it. So on the one side, we kind of want it to go all the way down and find some support and then bounce off of it. That's a much higher probability trade. But if it does come all the way down, we don't get our higher high. Excuse me, our higher low. And either way, I'm not talking about a rally back out, like back to all-time highs. We're talking about catching the next bear market rally, getting us into, like 39, 39.5, maybe 4K. Looking at where the futures are at this morning, we're not going to see this higher low. It looks like we're going to end up coming down and tagging it, right? But 35.71. All right, so looking at the volume this morning, we're well within range. A little bit of Goldilocks, right? It's not too heavy, it's not too light. Kind of just in the middle, it's just right. It's fine. It's no big deal. So we take it off, get rid of it. That's yesterday's low, yesterday's high. You can see how we were in sort of this compressed marketplace yesterday. It really didn't feel that compressed, to be completely honest about it. It didn't feel that compressed at all. But there we go. So we had an inside day breakout last night during the kill zone. Managed to get back inside it. We're going to be looking for another day just like this, right? Because it's all about CPI and PPI. We've managed to close the gap from Friday to Sunday, and we got a little bit of weakness. Now, when we're sitting in a market like this waiting for econ, what we'll often find is that you start to expand a little bit more on each side, right? So we kind of broke to the downside, but we didn't go anywhere. You're going to have an expectation that we're going to break to the upside, but not really go anywhere. And then we're just going to continue to do that. And the next time we come down, it would be a little bit deeper to the downside and then a little bit higher to the upside. And it's just chop, right? It's just moving around, it's chopping. But what we learned from that RSI Laguerre indicator is that when a market is doing this, it's also winding up more and more energy, right? And that's a word we don't normally associate with the market. We talk about inertia, trend, the strength of trend, momentum, we rarely talk about energy in a market, and I really believe that that's the uniqueness that Laguerre brings to the table. So we're just going to be sitting here winding up more and more and more energy. And the analogy that I use is those old toys that used to exist that you would wind the toy up and then set it down and it would do whatever until it unwound. And the more you cranked on that toy, the more energy it had in it, the longer it could do what it was supposed to do when you did let it go. Same situation here. It's just winding up more and more and more energy. Now, it's not promising direction, just that when the move happens, it's very likely to move with a big bang behind it. We do get the FOMC minutes tomorrow. The 10-year last night when I went to sleep was above 4%. It backed off, but I mean, it was at 4%. So, between CPI and the FOMC minutes, PPI, it's going to be a pretty impactful week, right? I mean, it's liable to be a little bit rough. Tomorrow we have the 10-year as an additional auction at 1 o'clock. Yeah, you like it. Now, the FOMC minutes, if you haven't really looked into this before, basically they summarize everything that they talked about in that closed meeting, and they kind of clean up the language a little bit, and then they publish this. And what's going on is everybody's going to go and parse through that word for word, looking for any kind of subtle hint or language. Because, things now are really different in the way that the Fed communicates compared to, say, 10 or 15 years ago, where it was all a lot more of the wink and nod, and you had to kind of read between the lines and read the tea leaves to try to figure out what they meant. Now they go out of their way to be as blatantly, obviously clear as they can without trying to slide in some hidden additional meanings. And yet you'll still find old school traders that will pick up on a particular phrase or tone and call it out as dovish or hawkish. But they're going to parse through this data, see who voted for what, who was leaning more heavily one direction or another, and then look for whatever they spoke about when it comes to their forward expectations, what criteria they were going to put on the table. So this isn't necessarily, quote, new data. When Powell came out after the FOMC, he gave a verbal summary of what they had talked about, right? Just a little bit. This is just going to be a more precise. So it's not a new FOMC. It's not another FOMC. It's just a release of data from the last FOMC. That doesn't mean that it won't cause a little bit of excitement. And it's tomorrow anyways. So until we get that data, we're very likely going to remain stagnant and sideways. The last CPI was on August 10. Seems like that ain't right. Right? Maybe I don't have the... Yeah, I don't have the September on there. It was a doozy. So I misspoke. It's not the August one. September 13th. You'd think I would have remembered that. Notice that down day. If you guys remember in the pre-market on that day, we had this massive, significant drop, right? I mean, it was straight down. There was no bounce to it, no trend, no nothing. It was just straight up drop like a brick in water. If you want to go back and look at that date, it was September 13th. Starting to ring some bells, perhaps. Now, all the estimates are kind of projecting that it's going to come in hot again, and we're going to get another event like that. So this is what you need to be prepared for in your portfolio, right? If you're holding on to trades and you're thinking, well, it's okay, I'm only down a little bit or I'm only up a little bit, I'm going to let it play out. Maybe we'll get a good move during the CPI. If you're short, hey, great. This is very likely going to, push you in the right direction really quick. But if you're long and you're holding on to some longs that perhaps, isn't doing so good yet, you might want to reconsider whether you still want to hold on to those. Because it's very likely to be a brutal, punishing drop. So for today, the expectation is that we're going to toe the line. We may, kind of wick around, dip around a little bit, but we're not expected to make significant changes. And that is going to be taken off the table if we get any kind of Forex contagion, right? So there's that little asterisk that we want to add to the discussion that says, yeah, we're not expecting anything. We're going to expect to toe the line unless. One of those unless would be, suppose the dollar just really starts to drop, breaks below 112, starts testing 11.5, maybe 111 flat. We see that, probably going to see the S&P break above 3,700. On the other side of that coin, you see the dollar break above, say, 114 today. We're very likely going to leg down and break this 35.71 pivot that I marked out. So a little bit of two sides on that. Energy going down is a good thing for us at the moment. If this begins to flip over and run back in the other direction, that could knock us out of this range as well. So the base case argument is we're going to stay range bound until we get those CPI and PPI numbers. Unless an event kicks off, right? And of course, if an event kicks off, then all bets are off. It's very likely going to look like this on the advanced decline line. A whole lot of chop, not a whole lot of assistance. You can see how the financials yesterday just wasn't really helping out. Same thing with technology. Cumulative tick, I mean, it was still pointing to the downside, but with the green line divergent like it was, we just really kind of just chopped around, right? We didn't really get anything out of it. That's going to be our expectation. So you want to look for signals that this is changing, right? That something's actually coming in, and keeping your eye on the markets that could cause this to change. Of course, watching the news helps, right? But that can get expensive, trying to pay for a bunch of different news aggregate services, things like that. And very often it's a little delayed or slow compared to what you can see if you're just watching the markets, right? Rather than watching a relay. It was a little bit of a surprise that we got above 145 with US dollar Japan and we didn't go parabolic. So a little surprise there. We are testing the 3-day. We're going to look for this to kind of settle down a little bit, break the 10-day, and get below it. You got to remember the bond market was closed yesterday. I believe a lot of Asian markets were closed last week. They were on a whole week holiday. I think it was China. So a lot of different markets closed. Everything should be open today. Nations around the world were open today. I don't think there was any holidays anywhere. We could start to see things shake out a little bit. Still expecting weakness in the British pound and the euro. Still expecting moves to the upside in Canada and China. This move in crude, this little pullback between yesterday, we broke that 3-period daily moving average. We're underneath it. We want to see if we're going to get that rebound. Right, I'm going to kind of zoom in a little bit more. You can see where these candles had broken below that moving average, but then they rallied back out of it. So this morning we are below that moving average, but it's still morning, right? We still got a good bit of time on the day where we could rally back out of it, and that's what we want to look for. The difference here, though, is that we've started that rollover, whereas before, when these other 3 candles went below it, we hadn't rolled over. So we've got a downward sloping moving average and a break below the moving average. Remember, first we test it, then we break through it. NASDAQ is weaker than the S&P when it comes to that pivot point from the other day, from October 3. Look for the tech versus finance to continue. Remember, normally it's tech and finance working together. Recently, we've seen a lot of tech versus finance. If NASDAQ breaks that pivot at 10,890 and it starts setting new lows on the year, we're very likely going to see tech take the market with it. Right? Semiconductors are still under pressure, a little bit from sanctions and from news and just all around. It's, the sector that hasn't gotten the beat down as much as anybody else, which leaves it sticking out. Bond volatility is still up, even though, we had that decrease yesterday. And energy volatility, or crude volatility, oil volatility, continues that downward move. And the VIX, now that Barclays got sued for manipulating the VIX, we're actually seeing more out of the VIX than we have seen for most of the year. It's still muted, I guess is a good word for it, but it's starting to respond a little bit more. We're going to be looking for the VIX to break above, call it 35, if things get rowdy today, right? If things start to unwind around the globe, somewhere between the FX markets and the bond markets, if things start to go crazy, a break above 35 would be one of your first indications that something is wrong. 30.25 has been and will continue to be for right now a bullish line in the sand. So we break below that, look for a beautiful leg up into 38, 3900 in the S&P. And the dollar is testing that yellow line. That yellow line is starting to flatten out a little bit. So we're going to be watching the dollar for that support to hold or not. We are underneath the daily pivot point, but we've already touched it, so it's not an MDP. There's no real gap to deal with. So really, I wouldn't expect much more than the same kind of activity that we got yesterday. The best we can hope for is a consistent, persistent move back up to around that 3660, 3670 area. It's likely to have a lot of chop. It's not going to be an easy ride, but as long as no news comes out today, then that's going to be our play. When we get back to the top, maybe sticking up through the top of it a little bit, overshooting the landing a little bit before we come back in. Just like we did when we broke out of the bottom down here. We went through it, kind of dabbled around down there, tested to see if it was going to hold, and then came back inside the box. Over the last few days, we really haven't had much of a change in the 10-day and our location to it, right? Our proximity to it. So how far away from the 10-day moving average? It's not much of a difference. Same thing with the weekly. Kind of just ties in with that whole thing of just holding the line and biding our time. Day 30-minute volume profile. Point of control is over our head. We're at the lower end of the box. When we're at the lower end of the box, we have every expectation that we will move to the top of the box and vice versa. To make that move to the top of the box, we have to get through the point of control. It's the most restrictive level of volume in our path. It's 3650 area. And there is nothing shallow until we get well beyond that. It starts to decrease around the 3710, the cog line area. So that's what we want to focus on. No way we're going to get there today unless, again, some crazy news comes out. We'll always put that on the table. Otherwise, without anything drastic, we're not likely to make a move like that. We would be lucky just to retest the highs of yesterday and maybe peek out of the top of it before coming back in the box and maintaining that range. No points of control to carry forward, no points of control underneath this. Now this choppy, sideways, misinformation, not a lot of data, this is very likely going to be across the board in just about anything that you could look at, right? So any of the good stuff that you would want to trade is very likely going to be doing the same thing. We do have the potential for, you know, a follow through on this TRB, the trend line breakover, but only back up to those previous levels, right? The CPI and the PPI are 100% in control. So I built these cumulative tick setups based on an old market breadth that we can't get with this kind of perspective on Thinkorswim unless we build it. Right? If you go over to this platform called TC2000, they have 3 or 4 market breadth studies that we don't have, not in their format. Right? And by market breadth studies, we're talking about things like UVol, DVol, tick trend, AD, those kind of old school market breadth indicators. So the one that we're looking at here is cumulative 4-week new high, new lows. And we don't really focus on the idea that my chart is set to the SPX because these indicators aren't looking at what symbol I'm on. That's why I have the little tag here to tell us which index this indicator is looking at. So here, this one is on the NYSE, and we're on a daily. This one's on the NYSE, and we're on a weekly. All right, so NYSE on top, NASDAQ on bottom, weekly on the right, daily on the left, and this middle grid here, that is the S&P, so that we have something to compare it to, right? So let's make sure that that is still the S&P, nothing changed. The S&P on the weekly is flirting with that 200 period moving average. As you can imagine, we don't very often break below the 200 period moving average on the SPX. If we are to break below that, things are very likely to get a little bit out of control, right? And the target is going to be the CPI high, or not the CPI high, the COVID high. Back in February of 2000, right before we tumbled and COVID hit the world and people started dying. 3380 area. So if we break the 200 on the 200 week, that'll be the leg down target. What we're looking at, why I'm bringing this this indicator up, is there's a level that needs to be defended or things kind of get out of control, and it wasn't defended. It was this June low, or July. On this indicator, it was July, but the market's breadth-wise, we needed to see this change, right? And that was a part of the rally that we got in July that lasted into August. And then it just rolled over, right? Everybody remembers what happened in August. We hit the 200 period daily moving average. We rejected off of it, and down we went. So this breadth indicator is a little bit of like a confirming signal, right? And we can find divergence with it, all kinds of things. Notice this little double bottom that we've got going on in the SPX, that little H pattern. It's not playing out in the market breadth. There was like no upward move here at all. None. It just flattened out a little bit before it continued to go lower. So while the S&P is really close to that June low in price, I mean, we're kind of just flirting right there with it. We're really struggling to try to keep it. It's being defended a lot. Breadth is way past it. Broke below it with conviction, it's still going. Now, my indicator that I built here is not exactly the same as those TC2000 tools. They're just as close as we can get with Thinkorswim, right? But that is significant. That's a major divergence between breadth and price. And that's the daily that we've been looking at, where I've been moving that chart back and forth. Here's the weekly. We broke that 200 already. We basically expanded outside of the weekly Bollinger Bands. And we're just pointed straight down with conviction. It hasn't turned sideways. We didn't get a leg up. Right? We didn't get any of this that we've got here on the S&P with that H pattern. So things are looking pretty nasty out there. Now this is the cumulative 4-week new high, new low. There's an argument that the better one, or the most insightful one, would be the cumulative volume. And I think that weekly kind of just tells the story perfectly. And you can see with the NASDAQ here, this is a must hold level. If we break this level, then we're very likely going to get that next leg down in the S&P and in the NASDAQ. So here's the SPX in the middle in purple. And you can see how they're much more similar, right? They're more in line with each other than those new high and new lows that we were looking at. But this is a must defend level. It's got to hold this level, or things are going to just get nasty out there. We're talking, 32, maybe 32.5. So watch the breadth. If you don't have this, there's a lot of different breadth indicators out there. There is a standard Thinkorswim advanced decline or cumulative breadth. It just won't look like this, right? But it'll get you pointed in the right direction. All right. Large caps, mega market caps, blue chip stocks, they're faring better than everything else. They've got still the most meat on the bone, and that includes semis, but not just, right? You got the monsters of tech, semis, anything that still has a reasonably decent chart compared to anything else. That is things that have a lot of room to fall. And then keep your eye out for any articles that are talking about redemptions. I've seen the word popping up more and more recently, and that's another part of the destruction process, right? Redemptions is forced selling. Those funds that have a minimum requirement to get in, say $1 million or $1.5 million. So Joe Schmo goes to them, gives them the $1 million. They're using his money. They're investing. They're not sitting in cash. Well, if he decides that he wants out of the game and he wants to cash in, they have to go sell to give Joe Schmo his money back. A lot of those funds are going to be in safer things, right? Things with a really low beta, boring, safe. Things like, I don't know, utilities. Did you see what happened to utilities in the last 2 weeks or so? So when these funds have to go out and sell a bunch of holdings to give Joe Schmo his money, then even the safe stuff starts to go down. Other people see it starting to go down and say, hey, you know what? I want my money back to cash me out wherever we're at. So it's redemptions. People getting out of funds having to sell to give the people back their money. Or not give them back their money, to cash them out and give them their money. So mega cap or blue chip, they're still looking reasonably decent. They're holding above that pivot. Tech itself, though, has tested that pivot, tested the lows, and while we're just flirting with it, we're just right there. Small caps, actually, it looks reasonably good compared to everything else, right? Gauge the distance of that pivot to the distance of this pivot. I'd say it's in line. Financials, however, are getting ready to go. And that makes sense since they've got earnings on the table. Careful with the data, guys. Watch the dollar and the VIX, the levels that we talked about. They're going to be your go-to to kind of give you a warning that this market is breaking loose. Otherwise, expect that chop and that nastiness to continue. And this might be a good week to, I don't know, take some days off, hang out with the family, go on a little mini vacation, let these numbers come out, and then trade the numbers. This will help you avoid just struggling with that chop. Be safe, everybody. I'll see y'all tomorrow.